For the past 4 years, the narrative surrounding Tennessee real estate was treated less like a market and more like a secular religion. The gospel was simple: if you build it, the out-of-state money will come and it will pay cash. We were told that the migration patterns from California, New York, and Illinois were permanent, irreversible, and fundamentally immune to national economic laws. It felt like an infinite equity machine. But right now, across the volunteer state, the neon lights are flickering out, the music is stopping, and are quiet. Desperate panic is unfolding behind the closed doors of cozy real estate offices. The numbers coming out of local multiple listing platforms are telling a story that nobody in a tailored suit wants to say out loud. We are witnessing an unprecedented collision of 3 distinct economic forces: a tidal wave of stagnant housing inventory, stubbornly high borrowing costs that refuse to budge, and a local home-buying population that has been completely, unequivocally tapped out. The leverage has completely inverted. The frantic price cuts flooding the market aren't just a minor seasonal correction. They are the early, violent tremors of a structural real estate meltdown that is dragging the entire state down with it. If you look past the glossy tourism brochures and drive the long stretch from the misty peaks of the Smoky Mountains all the way down to the muddy banks of the Mississippi River, the illusion completely dissolves. In its place, you find a sobering, undeniable trail of desperate sellers cutting prices by tens of thousands of dollars, and suddenly abandoned residential construction sites where developers simply ran out of money or nerve. The speculative fever has broken, leaving behind a massive economic hangover. The reality is that a housing market that was absolutely on fire just 24 months ago is now freezing over at record speed. To understand how we got here, we have to map out the 10 worst-hit municipalities across Tennessee. This isn't just about declining asset values, it is about tracking exactly where local economies are bleeding equity the fastest and understanding the geographic and economic traps that are catching unsuspecting buyers off guard. Navigating this treacherous landscape requires looking at the raw data, ignoring the marketing hype, and realizing that buying into these markets right now is the financial equivalent of trying to catch a falling knife. And you will want to hold your breath until we reach the absolute bottom of this list. Deep within the heart of Tennessee's real estate ecosystem sits one highly celebrated cultural hub that is currently staring down a truly catastrophic 41% crash in specific home values. That is not a typo. A 41% wipeout in an asset class that was marketed as a bulletproof safe haven. It is a staggering, historic collapse that threatens to completely erase the net worth of an entire generation of pandemic-era investors who thought the party would never end. The crisis is no longer looming in the distance. Happening right now, block by block, subdivision by subdivision, from the military towns on the northern border to the historic commuter rings of the mid-state. The working-class families who keep these communities running have been entirely priced out of their own backyards, while the speculative capital that caused the problem is beginning to sprint for the exits. The trap is snapping shut, and the wreckage is about to become impossible to hide. To trace the structural origins of this real estate freeze, one must look at the specific convergence of federal monetary policy, state-level tax incentives, and local geographic realities that transformed Tennessee into a speculative lightning rod. The roots of the current crisis were planted long before the pandemic, but the velocity of the market shifted permanently between 2020 and 2022. During this period, the Federal Reserve maintained the federal funds rate at a near-zero boundary, while executing massive quantitative easing programs that suppressed national mortgage rates to historic lows of under 3%. Concurrently, Tennessee's status as one of only 9 states with no individual income tax served as a powerful economic catalyst, drawing high-earning remote workers and corporate relocations seeking capital preservation. This influx of capital encountered severe geographic and zoning traps across the state's major municipalities. In East Tennessee, cities like Knoxville and Johnson City are structurally constrained by Appalachian topography, with ridgelines and protected valley configurations sharply limiting the supply of developable flat land. In Middle Tennessee, particularly within the Nashville Metropolitan Statistical Area, the constraint was not topographical, but political and infrastructural. Local planning commissions heavily relied on outdated zoning laws that favored low-density, single-family detached housing, creating an artificial supply squeeze just as demand experienced a vertical spike as out-of-state institutional capital and retail buyers flooded these regions. Home prices detached completely from local wage structures. Data from the Bureau of Labor Statistics indicates that while median household incomes in Tennessee hovered around $62,000, the median sale price of a home in select metropolitan areas surged well past $400,000. This created a profound mathematical imbalance. Local service sector and blue-collar workers, whose wages grew at an average annual rate of less than 3%, were systematically priced out of the market by buyers utilizing equity liquidated from significantly higher cost states like California and New York. The financial infrastructure supporting this boom began to crack when the Federal Reserve initiated an aggressive monetary tightening cycle, raising the benchmark interest rate by 500 basis points over a short period. This shifted average 30-year fixed mortgage rates from approximately 3% to over 7%, effectively doubling the monthly debt service for a standard residential loan. In tertiary markets and commuter suburbs, where home prices had been artificially inflated by the assumption of permanent low-cost capital, the impact was immediate. An examination of specific municipal data illustrates the rapid onset of this deceleration. In Clarksville, positioned adjacent to the Fort Campbell military installation, the real estate market had functioned as a low-cost sanctuary. When active listings surged by over 42% year-over-year, the median days on market ballooned from 18 days to 45 days, according to the Federal Reserve Bank of St. Louis. This sudden deceleration trapped amateur flippers who had assumed brief holding periods and minimal carrying costs. A parallel trajectory occurred in the Appalachian Highlands of Johnson City. As remote work trends normalized and corporate mandates forced workers back to physical offices, the localized demand cratered by 22%. The local Association of Realtors documented a 55% spike in unsold single-family home inventory. Home builders and individual sellers, operating under outdated valuation models, continued to list properties at peak prices, resulting in a complete freeze in transaction volume as buyers refused to accept the inflated valuations. Further south, in the logistical transit hub of Jackson, the market experienced a 7.5% reduction in median listing prices within a single quarter, paired with a 60% increase in active inventory. Mortgage application data from the Mortgage Bankers Association revealed a 38% drop in regional loan originations, driven primarily by a 15% increase in loan denials. Local buyers simply could not satisfy strict debt-to-income ratios under the combined weight of inflated asset prices and elevated interest rates. In Murfreesboro, a prominent commuter node 30 miles southeast of Nashville, national home builders aggressively overbuilt suburban subdivisions throughout the early 2020s. This uninhibited expansion resulted in a 71% year-over-year spike in new construction inventory. As the absorption rate slowed from 2 months to 5.5 months, developers were forced to implement aggressive concession strategies, including permanent interest rate buy-downs and structural price reductions, which immediately devalued existing homes in the surrounding area and pushed 20% of recent conventional borrowers toward negative equity. The historical trajectory shows that the current housing contraction is not an isolated anomaly, but the direct consequence of artificial demand meeting an inflexible, fragile infrastructure. The policy decisions that encouraged rapid growth without matching infrastructure development or local wage synchronization have created a rigid economic landscape. As institutional investors pull back their capital and local buyers remain constrained by affordability limits, the entire regional market faces a protracted period of structural realignment. The current reality across the Tennessee housing market has evolved into a highly visible gridlock between institutional expectations and local economic constraints. Across the reigning municipalities on the critical list, the collision between legacy pricing models and shifting consumer demand is exposing a profound structural vulnerability. Rather than a soft landing, municipal registries and regional multiple listing services are documenting a sharp escalation in inventory stagnation, deep institutional pullbacks, and a rising wave of distressed assets entering municipal court systems in Columbia, situated in Maury County. The residential sector has experienced a severe contraction. Pending home sales have plunged by 33% over the past 12 months. Data compiled by property platforms indicates a 65% surge in active listings featuring major price reductions. The median duration a home remains on the market has stretched to 68 days. This shift has triggered a sharp contraction in local real estate transactions, which is heavily impacting municipal revenue models that are dependent on recordation taxes and development fees. The Federal Reserve Bank has noted that regional debt-to-income ratios have moved deep into negative territory, while Atom Data Solutions recorded a 22% increase in distressed property filings within the county over the last 2 quarters, further southeast in Chattanooga. The real estate market is grappling with a severe correction within its high-end and luxury segments. Volume metrics from Redfin show that residential sales in the top 5% of the market have declined by 44%. This decline is happening concurrently with a 48% year-over-year increase in overall active residential inventory. Local census assessments place the median household income for the city at approximately $62,000, a figure completely disconnected from the carrying costs of properties originally priced for incoming out-of-state technology workers. The rental market reflects this broader imbalance, with local vacancy rates rising to 8.5%. Property management firms have resorted to widespread concession structures, including multi-month rent waivers, to stabilize occupancy rates. Furthermore, recent county tax assessments have increased average property tax obligations by 15%, further pressuring the cash flow metrics of smaller real estate portfolios. In the Knoxville metropolitan area, transactional dynamics have shifted profoundly. Closed residential transactions have dropped by 29% over a trailing 12-month period. 36% of all active listings in the region have undergone at least one formal price reduction. According to market data from RealPage, annual rent growth in the metropolitan area has rapidly decelerated to a negligible 0.5%. This deceleration is causing significant financial strain for institutional student housing operators and private landlords positioned near the University of Tennessee campus. The Mortgage Bankers Association recently documented a 1 2/10% increase in local mortgage delinquency rates within a single quarter, while foreclosure initiations rose by 25% compared to parallel historical intervals in Spring Hill, a major suburb traversing Williamson and Maury counties. The residential market has been flooded with unabsorbed inventory. Analytical reports from John Burns Research and Consulting indicate that home cancellation rates among regional builders have climbed to approximately 22%, as buyers opt to forfeit earnest money deposits rather than close on depreciating assets. Resale properties are facing severe competition from national homebuilders who are liquidating assets via aggressive price cuts and substantial design incentives. The average time on market for a resale property in Spring Hill has risen to 61 days, up from single digits 2 years prior. Total active residential inventory in this suburban corridor has expanded by 85% year-over-year, which is occurring alongside an average 12% increase in local property tax bills due to recent municipal reassessments. The situation in Memphis reveals a distinct crisis centered around institutional investment. County deed registries show that purchases by institutional investors and hedge funds have collapsed by 75% compared to peak levels. This abrupt pullback has left thousands of single-family rentals in a state of deferred maintenance, severely impacting property values in working-class neighborhoods. Active residential listings across the Memphis metropolitan area have expanded by 52%, while key zip codes have recorded absolute median price drops exceeding 12%. According to Apartment List, the residential vacancy rate in Memphis has reached 10.2%, positioning it among the highest vacancy metrics in the nation. Atom Data Solutions reports that foreclosure rates within Shelby County are now tracking 40% higher than the national average. with 42% of all active listings requiring significant price reductions to attract buyers. The operational breakdown across these municipal corridors demonstrates that the real estate freeze is no longer a localized phenomenon. The institutional capital that artificially inflated home prices relative to local wages is exiting the market, leaving local infrastructure and individual property owners to bear the full weight of the adjustment. The accumulation of unsold inventory, rising default metrics, and